everyone. My name is Jamie Gruber, and welcome to the Multifamily and More Expert Series, where we dive deep into a specific topic with our expert guest in the area of real estate, mindset, or anything in between. Today's guest, Ted Lanzaro, is a CPA, licensed CPA, real estate friendly, which is very important. He's also the host of the Tax Smart Investor podcast and wrote the book, The Tax Smart Landlord. Ted's approach is to take a proactive approach to strategic tax planning. For some reason, I can't get over that. And I want to start our conversation there. But first, welcome, Ted. How's everything going?
Thanks, Jamie. Well, I appreciate it, man. Thanks for having me on.
Absolutely. So you take a proactive approach to strategic tax planning. What does that mean? What does that look like?
So I'm not the kind of CPA, right, who you just bring your shoebox to on April 14th to get your taxes done, right? So with my clients, I'm actively involved in their real estate businesses from a consulting and tax standpoint year round. Okay, so I always tell my clients, I want to know when you buy a property, when you sell a property, when you're renovating a property, and before year end, we're going to do some tax planning. Okay, so there's these specific times in the year and specific instances that I do want to talk to them, because when you buy a property, there's specific tax strategies that you want to start to implement after the closing. When you sell a property, there's specific things you want to do for tax purposes before the closing, right? That you can't do after the closing, right? Like, you should figure out what the gain on the sale is, so you know whether you need to implement any tax strategies to help you defer the capital gains on the sale. So that's one example. So when people are selling a property, I say, look, call me before you close, right? Because almost all good proactive tax planning is done before the end of the year, and in the case of a sale, before the actual sale closes. Right?
That makes a lot of sense. So yeah, because I talk to my CPA maybe 2 times, 3 times a year, to your point, right? Like, it's more, not that I come with a shoebox on April 14th, but to an extent, it's like until the beginning of the year, I'm really not ramping up too much. But there have been, I guess, occasions where I do. But for you, you're that doctor who's checking in on their patient constantly, right? You're not just letting it go throughout the year. You're making sure that you are proactively engaged throughout every transaction, so that you're out in front of whatever may be coming from a tax perspective, based on whatever an investor might be doing.
Yeah, and the other side of that is that I'm an active investor. So I'm buying houses. I've bought and rehabbed and flipped over 40 houses in my career. I've been an active landlord. I've done some small syndications. So I bring, and that's me. And then with my clients, I've done typically just about everything from, representing, shopping malls and office buildings, right down to the guy who owns a 2-family house. So, for example, when you're renovating a property, right? So I know quite a bit about renovating a property. I also know quite a bit about how to renovate a property in a tax effective manner, right? Yeah. So when we talk about doing renovations, there's a difference between a repair and an improvement, right? And the difference of repair is immediately deductible in the year you do the repair. Okay. Improvement has to be put on your depreciation schedule as a fixed asset, and typically is going to get depreciated with a residential property over 27 and a half years, and on a commercial property over 39 years, right? So, and I'll give you just one quick example.
Sure.
Let's say you need to do a floor repair, right? The flooring in one of your apartments is messed up, right? So now, if you repair that flooring, even if you rip it out and replace it, but you do it with the same standard of materials that was there, right? So carpeting to carpeting, linoleum to linoleum, right? Then that's considered a repair, and that's immediately deductible, right? Now, if I go into that same apartment and I rip up the linoleum and I put hardwood floors down, that's an improvement. And now I've got to depreciate those hardwood floors, and they're going to be depreciated over 27 and a half years. So if I spend $2,750, then I get to depreciate $100 a year for 27 and a half years. It's kind of silly, right?
Yeah.
So the other way to do that is, if I want something to be a repair, right, I only fix some of it, right? I don't fix all of it. And if I fix some of it, then it's a repair. It's not an improvement, because I would have to, in order to improve something, I have to put it into like new condition
Mm-hmm.
and raise the value. I have to use superior materials. Okay, so that's important when we talk to, well, so there's not a lot of CPAs who, when you call them and say, hey, I'm going to do some renovating on one of my apartments, will ask you, okay, well, what's your scope of work? Can you send that over to me? Let me take a look at it.
Right. That's a great point. It's funny. I forget where I posted or somebody posted, and there was a discussion online from, I think, a CPA who said, I don't think it's that important that a CPA is also an investor. And while I guess I get that, I mean, I don't think you have to necessarily invest yourself in order to be educated on all the intricacies and ins and outs of the tax code for a real estate investor's perspective. But I'm just curious, what say you on that? How important is it that you are an investor? Is it just because you speak the language and have credibility instantly with your clients, or do you think it gives you a leg up as an accountant in helping people plan that are investors?
Yeah, I really think it does. I mean, this is my, obviously my opinion, okay, and
Yeah, mine too.
I'm obviously biased, right? 'Cause, this is what I do for a living. But here's the thing: there's a lot of great CPAs out there, and there's a lot of great generalists out there who are perfect for, just doing your taxes, right? But real estate is kind of a specific thing with its own set of rules, right?
Yeah.
So when you are an investor like myself, right, I'm using those rules for myself, so I have to know them because it's in my interest to cut my own taxes. So now I learn for myself and then bring it to my clients. But the real advantage of that is the knowledge that we were just talking about, which is knowing the specifics of being able to look at a scope of work and say, if you do this, you can call it a repair, because this looks like an improvement here. This $4,000 line item that you're going to do, here's a better way to do that, right? And you only get that with the investment experience. Right?
That's so true. I look at it like a pediatrician who's also a parent, right? Like, there's pediatrician could be a pediatrician. They're trained. They are a doctor. They understand way more than I do about my child's anatomy and makeup and development and everything else. But boy, when they're a parent and they talk about it, and most of them do that I've dealt with anyway, from like, yeah, hey, here's my medical opinion. Look, as a parent, there's just something comforting about that I don't want to call my kid my asset, but my bundle of joy here is in the hands of a professional and a person that understands what it is to have one of these. And it's the same sort of thing, right? For you, you are not only a professional and you understand the tax code, as many CPAs do, but boy, just the fact that you speak that language and know the nuances and the nitty gritty, you can speak from that experience. I don't know. I'm like you. I'm biased. My opinion is that an investor CPA is just another level from an investor-friendly CPA only. So, but that's just me.
Right.
So,
yeah.
but
No, I was going to say, I think that's accurate, because you can give a viewpoint that only an investor can give, because uh, it's the same thing. Don't let asbestos in the house scare you. Don't let mold scare you. There's a lot of CPAs, if you went to their office and said, "Oh, I'm going to buy a house with mold in it," well, what are you going to do that for? That sounds terrible, right? Doesn't it? But because they're not investors, so you can know the tax law, right? And that's great. You should. But be able to do those value add kind of things and say, look, this is how I've structured something in the past, or this is how I've repaired something where it didn't cost me $10,000. You could do that for $2,000 if you do it this way, for example. And just it's more like practical know-how, and that's a value add, in my opinion, to be able to do that for other investors.
I agree. We'll let the folks decide, but I do completely agree with what you
Yeah.
said. So you've already given a great point, a great tip on repair versus improvement, and how going a level up can actually cost you from a tax perspective. And that might be putting words in your mouth, but the flooring example you gave, linoleum to linoleum is a repair, linoleum to hardwood, now you're talking an improvement, and your ability to write that off changes, obviously, right? Which is awesome. The cool thing is you are going to be coming back in December to be our virtual mastermind guest, which means we're going to get a full hour with you as a community to pick your brain, strategically doing it at the end of the year before you get too crazy busy. But also as people are starting to think about their tax preparation for the next year and everything. So we're going to go deep on a bunch of stuff. We're going to throw it all out there and get people's questions answered. Taxes are always a huge topic for investors. So one, thank you for coming back and doing that.
Oh,
But
no problem. My pleasure.
secondly, why don't we give a little, let's drop a tease. Give me an example of something that we might talk about, something in the tax code, something that you think would be of benefit to folks, so they get an idea of what kind of content we'll have in December when you and I chat about taxes.
Well, I think, one of the really basic things that people need to know is what kind of investor are they for tax purposes, right? So there's three kinds of investors for tax purposes, each with their own separate tax treatment, right?
Mm-hmm.
So you have your passive investors, okay? So these are people who they are either investing in other people's deals as limited partners, so they have no control over a deal, they're just putting their money in for a return, or they do own their own properties, but they have them managed professionally, right? Or it could be somebody who is actively investing and actively owning their own properties, but they make over $150,000 a year of gross income, and by the IRS rules, the IRS classifies them as passive. And when you're classified as passive, you cannot take you cannot take rental losses against your ordinary income. So that becomes an important factor.
Yeah.
So the second kind of investor is an active investor, right? And an active investor is somebody who makes less than $150,000 a year, owns and manages their own properties, right? And they're allowed to take up to $25,000 a year of rental losses against their ordinary income. So if they have a W-2 job and they're investing, let's say they make $100,000 a year at their W-2 job, and then they go out and they buy a bunch of multifamily properties, and they're renting them out, and they're not typically going to have losses per se. Like, I hope they're not having negative cash flow. They're getting actual money in, but with the depreciation on the properties, they actually show a net loss. Yeah. That net loss up to $25,000 can be used to offset their ordinary income. So now, if you have $100,000 of income and a $25,000 rental loss from depreciation, you're only paying taxes on $75,000. So you've sheltered the cash flow on your rental income, and you've got an additional cash flow in the form of a refund on $25,000 of your income. So that's great. That's being an active investor. The third category is real estate professional. And as a real estate professional, there are certain rules that you need to qualify. We'll talk about that in December. But the best part of being a real estate professional is that you can have unlimited deductibility against your earned income. So if you're a real estate broker and you made a huge commission, let's say you have a $300,000 commission on your brokerage, now you can go and you can say buy a property, cost segregate it, get a huge depreciation deduction, which you can then subsequently use against your ordinary income, brokerage income. So that's kind of where the planning comes in. That's why when I say these major events, one of those major events, and I talk to my real estate professional clients about this, when you make a lot of money very quickly, when you have a big commission, call me. I want to know about that. That's what's being proactive is about, right? So we'll talk more about how to become a real estate professional and how to, even if you have a W-2 job, how you could make your spouse a real estate professional and get the same benefits. So it's going to be awesome.
That's this guy. No, this is the sexiest topic in the world to me. The whole concept of accelerated depreciation, real estate investor. I mean, this is tip of the iceberg stuff, guys. And we're going to have a ton of content in December, a bunch of little things. I mean, it blows my mind how much is out there that people don't know, me included. Actually, you just mentioned something in here that I wasn't aware of, but how much stuff is out there relative to the tax code that people can benefit from. But that real estate professional status, especially when you own multifamily and you accelerate the depreciation through a cost seg study, oh my God, if you are or your spouse is and you're filing jointly, it's amazing.
Yeah, yeah.
Best thing I could say.
There's a ton of value, and we'll talk about a few more things. And I tell you honestly, what I have found is that probably 90% of people are leaving money on the table.
Yeah, I could see that. I know I'm probably still like even as good as I feel my accountant is and everything. But for disclosure, I just met Ted recently. I've had my accountant for years. This isn't a
Right.
but uh but yeah, as good as she I think is, I'm sure for me I'm doing certain things or not thinking of holding, of tracking certain things that could get me a better tax benefit than I'm actually getting. But yeah, like you said, so much to talk about, so much to get into. That's very, very exciting. So Ted, how can people in advance of that learn more about you, get a hold of you, whatever it may be? Where can we find you?
Okay, well, you can go to my website, which is www.lanzarocpa.com. That's LANZAROCPA.com. You can also find me on Facebook. Just type in Ted Lanzaro, and you can be my friend on Facebook, and you can like my TaxSmart landlord page and my Lanzaro CPA page. And we put out probably 2 or 3 videos and podcasts a week of content, all about taxation for real estate investors, all different topics. So we put out a lot of great information. If you're following those pages, then you get access to all of that information. You can also email me at TED at LANZAROCPA.com. That's my email address. And my phone number is on my website, so you feel free to give me a call. All of those ways are great ways to connect with me.
Beautiful. No, that's amazing to think about like how much there is to being an investor and the tax code when you're releasing 2 to 3 pieces of content that are different every week related to taxes. That's insane. Absolutely insane. So,
Yeah, and some of it is investor stuff also.
yeah.
So some of it is just investor tips, but a lot of it and some of it is just kind of a hybrid,
Yeah.
because it does work hand in hand.
There's just that much to it is the point. There's so much you can get out of a
Yeah,
good CPA, and we're going to all benefit from you, thankfully. We have today, and we will again once we meet in December. So great. Look for that, everyone. The event will be updated in all of the multifamily and more groups. I'll make sure to blast it out like I do everything else. Until then, Ted, I really appreciate you coming on, and thanks for your time today.
I appreciate you having me, Jamie. Thank you so much.